Let's talk about this economy and the consumer. You are the #1 small business lender in the country. You've got a massive retail business. What are you seeing right now versus where we were, say, 12 months ago?
So we got 66 million consumers, and we track every week sort of how they move money in and out of their accounts. So credit, debit card spending, checks written, cash out of the ATM, Zelle payments, and everything. And so over the last 12 months, they've gone from a year-over-year growth rate in the first part of 23 versus 22 of 10% down to a year-over-year growth rate now of 4.5%, 5% in December, in the first part of January. Pretty consistent since the midsummer. Now, that's good news and bad news. The good news is it's slowed down because it's more consistent where it was 16, 17, 18, sort of a low inflation, lower growth economy, meaning the drag effect is starting to tame their behavior, which helps fuel inflation. The bad news is, as they're slowing down, our core prediction by our research team, which is the best in the world, is we go from almost a 4.5, whatever it was in the third quarter growth rate, to a 1% positive, soft landing, but still a quick slowdown.
Mike Gapin, who leads that team on the economic side of things, looking for that early rate cut from the Federal Reserve in, say, March. Based on what you are seeing, do you think that's necessary, that the Federal Reserve would need to be doing that as early as March?
Well, you've seen the market play out here, a pretty good swing on that debate. But
getting squeezed.
Our core team has 4 cuts. And 4 cuts, 24 and 25. And so if you sort of sort that through, people wouldn't interpret that, but that is actually higher for longer because you came off of 25 basis points, and if you end up at 3.5 next year, 8 quarters away from now. So I think the team, Mike and the team, they're saying they're going to have to start cutting because they have the space to cut and the economy can keep growing. And the last thing you want to do is tip this thing over. And so the consumer spending in good shape, their credit's in pretty good shape, the credit statistics, everybody's it's normalizing. It's normalizing at 19 and 18. Those are like 50-year good records in our company. It's not normalizing to stress. It's normalizing the base case. So if you think about that, they've got access to credit. Inflation hurts, especially median income. That's tough on people. That's what you read about. But in the end of the day, they've got it set up so they have to start cutting lest the drag gets too strong. And the housing market's got to get a little more oomph to it. You've got to get car purchases up. You got to get these things that kind of keep the economy rolling on.
Just on that housing point, how much do rates have to drop before you really see the mortgage market come back?
Well, I think there'll be 2 parts to that equation. If you got all the people in the consumer say, if you get a 6 handle consistently, or even high 5s, low 6s, then people sort of get. You just need time too. And so when I got my first mortgage at 8.5, I thought I had a deal. I first went into business and the prime rate was 23. And so, but everybody's used to that. People aren't used to this. So it's going to just take time for them to think about it differently and get used to the pricing's got to flatten out and adjust. Their wages have to come up. But the good news is, most Americans have a fixed-rate mortgage, which in an inverse sort of is an asset right now and to have against the market. And so it's going to be slow in the first part of next year. It should start picking up as people get more and more used to this. And frankly, there's just a turnover in housing because people get divorced, get sick, you die, move to a bigger house. Those are very pleasant things.
Exactly.
But the reality is that's what happens.
That's what we need to unlock the housing market.
So there's always an activity. It's just that the refinance activity is mortgage-driven, but that's done for a while. But the purchase activity will pick up because people have kids and want houses and things like that.
I'm curious, in your earnings call, you expressed some cautiousness around your outlook.
Yeah.
Other CEOs of certain financial firms have been less so, particularly at this Davos meeting. Talk about hiring, talking about the incredible boom in M&A, IPOs, everything coming back. How do you explain the difference?
Well, we're cautious because the economy is slowing down, and that's just how you have to manage expenses. We have a big enterprise. We, over the course of last year, probably went down 4,000 or 5,000 headcount. We still hired 15,000 people last year. So we are always hiring. People hire 1,000 to 1,500 people a month. And with a turnover rate, which has actually gone down to 6% now, probably the lowest we've ever had in reasonably normal times in the company's history that we can find, you don't have to hire as many as you did in the Great Resignation. So we look 3 years out for headcount. We plan into it, but it's how you keep the expenses. At the end of the day, our expense base is $63 billion. 40 billion is people. And so it's all about managing people and then using AI and technology and applied technology to take work away and then migrate people to other places we need to work. And so are we hiring commercial bankers? Absolutely. Financial advisors? Absolutely. Middle market investment bankers? We'll probably double that staff for the next couple of years. Are we hiring salespeople in the branches? Yes, but at the same time, the service side of that keeps going more digitized and automated. Even deep in, we had 1.2 billion digital interactions in consumer last quarter. Just think about that. And you still have a lot that isn't. So you're always getting a benefit of that. So it's a balance. Core economy we think is solid. Most people think I'm optimistic. I'm just giving you the facts of what our talented team tells us. But at the end of the day, you have to manage expenses because as NI flattens out and then starts growing, net interest income, that's 60% of our revenue. So you got to make sure the expenses are in line with it.
The next question. Basel III Endgame.
Yeah.
It sounds like a bad movie. Let's talk about it. Given what's proposed, do you think it will go through as proposed? And let's start with what's proposed. What are the conversations, what do they sound like between you and regulators at the moment?
I think there's an openness. You don't have to really take what I say. Just listen to the people who are going to actually have the vote. The people who actually have to approve it, and the difference of opinion, which is a bit unusual, honestly. I've been doing this stuff around 40 years, and I've never seen the board itself have out in the open divergence of opinion, and that's because what it affects is so penetrative across the society. Small business lending, mortgages, tax credit equity deals, trading things. So a lot of what you heard after the financial crisis really had about 10 or 12 of us that, were making adjustments that, and then another group came behind. This goes deep in the thing. That's what you're hearing more noise. And of course, they're going to their Congress team people. They're going to the regulators and saying, wait a second, is this what you want to do? And so I think that means there's going to be debate around changing it and probably change, but we'll see it play out. And even the Fed itself has said that. Do they have to change it? Yes, because I don't think it's the right balance. And that's why the comment letters flooded in Tuesday or whenever it was all over the place. And, we've made the points clear. 20% increase our capital doesn't seem to make sense given where we are. Now, we have $195 billion of regulatory capital. After you do this calculation, we need $195 billion of regular capital. All sounds easy, except for the $30 billion that was excess right now. You ought to be able to go out and make loans with or do something. That's like $500 or $600 billion of lending capacity that just got taken away overnight. If this goes through, we're not sure that's the right judgment right now.
There is this story that's going around at the moment, and I'd love your perspective on it. On the asset management side of things, they talk about debanking. They talk about a lot of this activity shifting to private credit markets. Can you give me your perspective on that? How do you think that would really work out in practice?
So if you take a long arc, it's done. What we're talking about now is a sort of private lending at the edge, which is sort of upper middle market leveraged lending and things. But if you think about the mortgage market, you think about the home equity market is still with the banks because of difficulty of revolvers. The credit card market is with the big banks, but it's actually, we took it through a non-bank capacity, us with MBNA, for example, and brought it back. So we own it, but it was built in a different context when it took off. You go to anything but core small business lending, core middle market lending, auto lending, almost every class is half outside the banking system today. That is not the worst thing because that means capital gets leveraged different ways and the market speaks and drives it, and that's what Europe doesn't have, is that kind of deep capital markets allow them to get the capacity. It's good for fees and investment banking, capital markets. It's not a great thing when a company is under stress, and that's what the question of a $300 million company in a private loan fund where you don't have a workout attitude, you have a trading attitude towards it, which is not right or wrong, it's just a different attitude. That'll be an interesting question, how that reverberates in the economy, but it's largely out there, and we're talking at the margin about these private loan funds, which is really a very narrow category.
Are you thinking about getting into private credit?
We are. We have $500 billion of commercial loans, $1 trillion of commitments. They're all private credit loans. We don't do highly leveraged transactions. It's hard for us to do.
Can you compete with the Apollos of the world? That's what I mean.
I think we competed with them yesterday. And tomorrow. So I think we'll be fine.
Going forward, though, is this going to be a part of your revenue, especially as you are concerned about some of the risks that are building? So you said, you seem to hint that there's some risk building that's just sort of out of the purview of regulators if it's just shifting elsewhere.
And so the FSOC was conceptualized to deal with this, right? And you can't, it's hard for it to really deal with it because it's in what think net asset value funds, i.e. the asset value is not dependent on dollar deposits. So it's a little bit like, okay, a bunch of people lost some money. So if you look at what happened in the financial crisis for leveraged funds, and apply that to a bank balance sheet like ours, we'd have lost $500 billion, to give you a sense. It was a wipeout. It just got spread through the system. So that's why it's not an entirely bad thing to have that shock absorber. It goes in all our 401ks and all our pension funds and all that stuff. Not good, but it just spreads so widely people don't feel it. It's not dollar dependent lock that I got to give $1 back to the depositor. So there's some good things about this. These things ebb and flow and come and go and stuff, but a lot of it's stuff that we wouldn't do, and the stuff that we look at that we might do more of, we can easily accommodate with a couple $1 billion allocation to certain types of industries, a little more barely passed credits versus fully passed credit. We can do it and be competitive, but it's really at the margin.
Final question. You know how it works out at Davos this week. If you have an American accent, you'll be asked about the American election and the prospects of Donald Trump coming back. I won't go there. I will ask you this, though, and you'll be used to this on Wall Street. If you are a successful banker on Wall Street, you get asked this question. In 5 years' time, will it be Secretary Moynihan? Is that how this is going to work out?
I've got a big job, and I have a fun job, more importantly, and I got a lot of years ahead of me.
Doesn't sound like fun down in Washington.
I'll let you be the judge of that. But I think in the end of the day, look, I do what I do. I love doing it. We have a great company, and it's fun to do. But at the end of the day, we need good people serving Washington. It may not be me, but we need good people to serve there.